Please, you should not forget that financial management is very simple. All you need to know, all you need to do is to understand the principle. The principle is the rule of the game. If you don't understand the principle, you'll be left out. Please, I want to believe that I've sent a note on the sources of finance. Please, it is very important for you to read that sources of finance. Of course, there is calculation. We'll do that in our intensive class for those who will continue with us or for the intensive. And please, I purposely leave working capital because working capital, we can take it. We are familiar with working capital. So it is better we take what you are not familiar with so that we can quickly move. So that is the reason why I'm not even bothered about the what is it called? The working capital. Please. So in today's class, we have one question to solve. Oh, before the capital rationing. Okay, that's fine. I gave assignments. Question 11. I want to believe that every one of you, you've attempted it and you have a negative figure. If you have a negative figure, it is actually correct. I think someone did it. The last person that submit is actually correct on the negative figure. Well done. In today's class, we'll just pick the B part of the question. I purposely just want to treat the B part of the question. Should in case that would be the worst case scenario, right? The worst case scenario. So please, who will read the requirements before we move to replacement theory, please? Who will assist us to read the requirement? Please, can you see my screen? Please, can you see my screen?
Yes, we can.
Okay, thank you. Thank you. So please can someone read the requirement quickly?
Let me read.
Okay, please.
Okay. Required. Calculate the nominal after-tax net present value of project E and comment on the financial acceptability of this project. 14 marks.
Yes, based on that, I think we've done that already. It was assignment. I think it has a negative NPV, right? So you comment on it, it will not be viable. Okay, the B part.
Calculate the maximum net present value which can be obtained from investing the fund of $10 million, assuming here that the nominal after-tax NPV of project E is 0.
Okay, thank you. This is 10 million naira. Class. Once you just see a question like this, and you have to calculate the maximum NPV. Maximum NPV usually is on capital rationing. Class, let me quickly do a quick recap on something. Under the theory of risk and uncertainty, when they give you probability, and the probability is being attached to either variable cost or a fixed cost, you calculate what we call expected value. Please, whenever you are given a probability attached to any items, any variables, what you need to calculate is what we call expected value. Now, we have here the maximum NPV. What is maximum NPV? This is to show that you have to do a capital rationing, and which can be obtained from investing the fund of 10 million meaning that they want to invest just 10 million. Assuming in this particular question, this B, that the nominal after tax, NPV of project E is 0. Assuming that the project E is 0 and they want to allocate 10 million in this question, what will be the maximum NPV class? So we don't know if we have divisible or indivisible. So we have to read the question and understand if we are to do maybe project A or project B, divisible or indivisible project, right? Now, the board of OAP and Co has decided to limit investment fund to 10 million. This was exactly the 10 million that was given here. 10 million class, right? 10 million, right? So that is what they have to invest. What they have to invest, it is just 10 million. Now for the next year, right? For the next year, and it's preparing its capital investment and the capital budgets, rather. The company is considering 5 projects. The company is considering 5 projects as follows. Initial investment, which is cost. Oh, okay. Then project A, the NPV is this. Project B, the NPV is this. Project C, the NPV is this. Project D, the NPV is this. Why the project E to be calculated, of which we've done that in A part of this question. Now, all 5 projects have a project life of 4 years. Class, the life of this project is just for 4 years. Project A, project B, project C, and project D are divisible projects. Class, what is divisible project? Can someone tell me what is divisible project?
They are projects that can be taken.
Okay. Divisible projects are projects that can be undertaken in parts. Meaning that when you want to do your capital rationing, project A or allocation, project A and project B, project C and project D are divisible projects. Class, it can be undertaken in parts. And project B and D are mutually exclusive. Class, when a project is mutually exclusive, what does that mean?
Serve the same purpose.
They serve the same purposes. So therefore, if you are undertaking B, you can leave D. If you want to undertake D, you leave B. That is the mutually exclusive. So we will do our allocation from the calculation of the NPV provided. Don't forget these steps. Number 1, you determine the determination of the NPV, right? The next is the profitability index. So now, all net present value are in nominal term, after tax terms. Project E. This is a strategically important project.
I can't see anything.
This is strategically important. Class, please, can you hear me?
Yes,
Can you
come.
Yes, sir.
Yes, sir.
Yes, sir.
So it's from your network, please. Don't use that to distract us, please. You can use the chat button, please. Thank you. Now, project E. This is a strategically important project which the board of OAP and Co have decided must be undertaken in order for the company to remain competitive, regardless of its financial acceptability. Meaning that project E is as important as anything. Project E, it is as important as anything. So even if the project has a negative NPV, it must be undertaken because it is strategically important for the company. Plus, that is, there is a restriction here. That is why the requirement says that assuming project A, project E is 0. You know, since it is 0, it should be the one to be, we should even allocate it. It should be the project to get fund last, like should be the last project because the NPV is 0. But because of the importance of the project, because it is strategically important, class, because the project is strategically important, since it is strategically important, we have to undertake it, even if it is negative NPV, right? And we're given the information. This information relates to the A part of the question. The focus are all this. This relates to the A part of the question, which I assumed you have attempted the question. Class. Project E is strategically important and it must be undertaken. Class. Even if it is negative NPV or 0, as stated here in B. Class. We must undertake project E. So therefore, a minute. So, since project E is strategically important, we must undertake project E from our allocation. Plus, we should not forget that the question says that project A, B, C, and D are divisible, meaning that they can be undertaken in parts, while project B and D are mutually exclusive. You can decide to undertake B and leave D, or you take D and leave B. Why project E is strategically important? Class. So the B part of this question, suggested solution. Suggested solution. Suggested solution. What is the name of the company? OAP and Co. Class. B. So we start with allocation. Since the NPV of each of the projects is given and project E NPV is 0. So therefore, we don't need to calculate the NPV, it is given. So we need to allocate the fund of 10 million. So therefore, we can have allocation. Available available. What is available is 10. Or before that, we need to determine our profitability index, sorry. The profitability index, so that we use that to do our ranking. Profitability index. Profitability index equals to MPV divided by the initial investments. Initial investment, project A. Class, what is the MPV of project A? I can copy this. Don't worry. I can just copy this. Right. Class, are we still together? Hello?
We are together, sir.
Yes, we are.
Okay, that's fine. So I can, okay. So project D, then project E. The initial investment of project E is 5 million. Is 5 million. 5 million. So don't forget that the B part of this question says that the examiner says that we should assume that project E MPV is 0. Class. So the MPV of project E will be 0. Project E. We should not equally forget that project E is strategically important for the company to gain a competitive advantage, and it must be undertaking. Project E. So now, the profitability index. Profitability index. Just a minute. Profitability index. Profitability index equals to profitability index equals to, if you divide 2.1 million divided by 2.5, what do you have?
0.4.
0.4.
0.4. 1,150,000 divided by 2,200,000. What do you have?
0.704.
0.7. Right. 1,350 divided by 2.6.
0.5.
0.5. Just the Sorry, please. So, what do we have here? 1.5,
0.7.
0.8. This will be 0, right?
The approximated figure D.
You can approximate. Is 80%? Now, class, what is the next step? Is to rank. Class. Ideally, we're supposed to start project D first for the ranking. But because in the question, the examiner says project E is strategically important. Class, project E is strategically important. Since project E is strategically important, you have to rank it first because it must be undertaken. That is the examiner point, class, that project E is strategically important and therefore it must be undertaken. It is a must. That is a restriction, class. So therefore, we can rank this first. Then this will be second. Next, this will be third. This will be fourth. Then we can have here to be fifth, class. Let me quickly go back. Let's go back to the question. Projects A, B, C, D are divisible. Project B and D are mutually exclusive. When you undertake B, you can forgo D, or you undertake D, you forgo B. Why project E is strategically important and it must be undertaken regardless of its financial availability or financial availability or acceptability, class. So there is a restriction, and that is the reason why we allocate project A first. So allocation to project E. Project E, we need 5 million to execute the projects. 5 million with the MPV of 0 because it is strategically important for the company. So we have to undertake it first. Available. When it is available, we have 5 million. Then allocation. Plus, don't forget that projects B and D are mutually exclusive. We can pick B and leave D. We can pick D and leave B because they serve the same purpose. So we allocate. We allocate to D. We will need 1.9. 1.9. If we need 1.9, the 1.9 will give us Class, the 1.9 will give us 1.5, right? Is that not so? So we have the 1.5. So what is the difference? Allocation to E to D. What is the difference?
3.1.
3,100,000. Next, we're supposed to allocate to B based on our ranking. But because project D and B are mutually exclusive projects, they serve the same purpose, we will not undertake project B. We will not allocate to project B because project D and B are mutually exclusive. So therefore, we have to undertake one, of which we'll allocate to D. Then we have to forgo B because they are mutually. So after the third ranking, next, class, next. Hello.
Sir, we are with you. We are with you, sir.
Yeah, we are with you.
So what's next? The next is C.
Project C.
Thank you. Allocation to C. Class. Allocation to C, 2.6. So it will give us 1,350,000 MPV. Next, what is available?
500,000.
500,000. Next, after the project C, what do we have again? Project D. Project what? Project A, right?
Project A.
Project A. We have 500,000 available. Therefore, A we need 2.5. So therefore, we can allocation to A. A we need 2.5. 2.5. Right? What happened? Rejoice.
Sir, this requirement for, I think, let me open my question. You said the projects, where is it said? Projects A, B, and this thing, they are all divisible, but that same project B appeared as mutually exclusive. Are we not supposed to like probably leave it since the
No.
first requirement was like it's
No.
part of divisible?
No. They are mutually exclusive. Undertake the project. Undertake all other projects first before you come back to it. Is that not so?
Okay.
Project D
Okay.
and B are mutually exclusive. So why will you now undertake it again? No, now.
Yeah.
You
Because
have
B is
to
still part of
undertake.
deceivable, I mean, divisible.
Leave it. You already have mutually exclusive. They've stated it that it is mutually exclusive.
Okay.
Is that not so?
Yes.
Just undertake one. Anyone that remain, you can now allocate to it. You can now do your allocation.
Okay. Okay.
Do you
Okay. Thank you.
understand?
Yes, sir.
Yeah. So what is the difference?
100,000.
Available. Available. Available is what? Available. What is the difference? 2.5, right?
Oh, it's 500,000. So I'm not carrying the 2.5 every time.
Okay. Yeah, that's true. That's true. I was thinking it's 5 millions. Thank you. That is, you see, allocation to A. A, we need 2.5. If A need 2.5, we only have 500. Is that now? We only have. No, you can't share it via WhatsApp. If you have your material, get it via the material. So if you have 500 allocation and A needs 2.5, we don't have that capacity. So execute the all 1 million. So therefore, we need to pick a certain percentage, meaning that 500,000 divided by the total cost needed for A, which is 2.5. How many percent are we going to use?
20%.
How many percent?
0.2.
20%.
0.2.
20%.
20%.
Meaning that we can only execute 20% of project A class. We can only execute 20% of project A. If you execute 20% of project A, meaning that we will not have the full 1 million to be the MPV.
310.
So therefore, we can have 20 divided by 100 times 1 million.
200,000.
200,000.
500,000.
500,000. So meaning that
It's 200,000.
is it 200,000?
200,000. 50% of 1 million. 200,000.
Meaning that we can only have 20% of the MPV of project A if we can only take 20% of the project. So what would be the maximum MPV? What would be the maximum MPV? Maximum MPV class.
3 million.
Should be 3,050,000.
3,050,000.
50,000.
This will be your maximum MPV of the P part of the question. We are done with this question. Can we move? Please. Your understanding of the question is very important. Leslie.
Good afternoon, sir. Good evening, sir.
Good evening.
Okay, sir, please, my question is about B and D that are mutually exclusive. Sorry, is it that we choose the lowest among the two when allocating?
What is mutually exclusive?
As in this, they serve the same purpose. The project serve the same purpose.
But when you do your ranking, which one comes first between the B and D?
The B came first.
How now?
D
came first
is
now.
third now. Okay. Okay, sir. Okay. But why we not seeing the okay. Thank you, sir. Thank you, sir.
That's fine.
Okay.
Okay. Can we move, please? It is what it is. Your understanding of the capital investment decision will assist you in capital rationing. What is the capital investment decision? Your understanding of mutually exclusive projects, divisible projects, dependent projects, independent projects, divisible projects, and non-divisible projects. We assist you while doing a capital rationing. So we are good. The business of the day is on replacement theory. So the C part of the question will be your assignment. Make sure you complete it. Discuss the reason why the board of OAP may have decided to limit investment fund for the next, discuss the reason why the board of OAP and Co may have decided to limit investment fund for the next year. Class, this will now take you to, this will take us to the causes of capital rationing. Class, we have the internal and we have the external. Then the C part of this question is saying that we should discuss the reason why the board of OAP may have decided to limit investment fund. It could be because of internal purpose. It could be because of external purpose. And that is it. Right, class? So you can do that. You have the note in your material. Please, can we move?
Yes, sir, we can move.
Thank you. Our
Okay, good evening, sir.
good
So my
evening.
question is in the project E. So since you asked us to go and solve the NPV for project E, and we did not make use of it in
That is what the
the right.
question says. That is what the
Okay.
question says. Can you see? B, calculate the maximum NPV value, which can be obtained from investing the fund of 10 million, assuming that the nominal after-tax NPV of project E is 0. And even if it is negative, it is strategically important. There is a restriction. You must undertake the project. It is very important. Please, class, can we move? Our next topic will be on portfolio theory. That will be 8:30. Right. But now we need to continue with a subtopic under the capital investment. Replacement theory. Class, I think the last two classes in SFM, I took decision tree and simulation. I forgot to add it to the playlist. Please, I will assume that I've covered the decision tree and simulation, because if you watch the video, you will understand simulation and decision tree. Then I will now give assignment. I will drop the assignment for decision tree. I will send it. Right, I'll send it. So please, I will add the decision tree to the playlist. Please go and watch it. Then imagine you have over 100 students in SFM. I took that topic And none of the students said they did not understand. Like, they didn't even, they say, IB, we can move on. That is how simplified it is. So please, I believe when you watch the video, you will understand the decision tree under the risk and uncertainty and simulation. So I will assume that I've covered decision tree and simulation. Lastly, is on the last one is on the last subtopic is replacement theory. Class. Replacement theory usually when company want to decide on when to replace their assets. Class. Illustration 13. You can also see the notes in replacement theory. Let me quickly check where you can see the notes. I think we've done a lot in investment appraisals. Okay, can check it after capital rationing. Can you see? Thank you. Now, replacement theory. Replacement theory is when organization want to decide the best way to replace their assets. Class. Replacement theory is when company decide the best way to replace their assets. The replacement could be on a yearly, the replacement could be every 1 year or every 2 years or 3 years. Now, it depends on the benefits as well as what? The cost reduction. Class, I hope I'm communicating. The replacement theory under the asset replacement, it is when organization or company decide when to replace their assets. But when they will decide on the decision on when to replace the asset will now depend on the benefits as well as the costs. Two things, the benefits as well as the cost. Now, if a machine has 4 years or the project is for 4 years and you can replace it, the project is for 4 years, and in that 4 years, maybe in year 1 you have positive NPV, in year 2 you have positive NPV, in year 3 you have positive NPV, in year 4 you have positive. Throughout the 4 years you have a positive NPV. Then you need to decide which one from which year gives the higher NPV. Anyone that gives you the higher NPV, you can now base your decision on maximization that they should replace every 3 years or 4 years because it will give high NPV, because it has higher NPV compared to other years. That is maximization when you have a positive NPV. In another case scenario, when you have minimization, now company can also decide when to replace, when they have what we call minimization. When they want to minimize costs, they can decide to replace, to look for NPV, the NPV that have the negative NPV. Maybe the project is for 4 years. Year 1 negative, year 2 negative, year 3 negative, year 4 negative. They have to look for the NPV that has the lowest costs, we know that it is costs, right? We know it is costs. We know that we will incur costs, but we need to look for the NPV. Since it is negative, we need to look for NPV that is what? That is negative. Class. That has lower, okay, sorry. The NPV that is negative with lowest costs. So organization can base their decision on a higher positive NPV, or a lowest costs of negative NPV to decide when to replace their assets. Class. So therefore, there is what we call expected annual, is it expected annual annuity? Okay, expected annual annuity. We'll calculate that. That is what we use to decide. But pick two things here. When the company will replace assets, it will depend on the year that has higher NPV. That is one. Maximization. So minimization, which now depends on a negative NPV that had that with the lowest negative NPV. So the organization will now pick the one that has a low negative, because it is a cost. We know, but when are we going to replace it? We need to choose wise by looking for the net present value, the negative net present value that has a lowest what? A lowest cost, lowest NPV, negative. You want negative NPV, the lowest one, right? The lowest what? The lowest one. So we now need to calculate what we call expected annual annuity. Of course, we will do that. It is that with that, it is that calculation that we're now based on our decision on, right? Class, are we still together?
Yes, sir.
Okay. So now there's a question here. Question illustration 13. Illustration 13. Are you there? For those who have the material, illustration 13. Please confirm if you can see my screen. We want to use this question to round up our class on investment appraisal. This has taken too long, right? Interesting. Yes, it is very important. So that is why we need to take our time to understand some things, right? And you should not forget that we'll do intensive. So get yourself ready for that. Though the details will be sent to the platform, to the group, I think on or before Monday, or even on Monday, so if you can see it, so that whatever thing you want to prepare, you can start the preparation now. So, of course, it is not mandatory for those who believe. Okay, let's continue with this first. Now, we have here, please, can someone read quickly? Kudus.
A restaurant.
Okay, coming. Kudus.
Yes, sir.
Someone said, anywhere I see you, I should be you. That you get money to your hand.
That one is not true. It's from liar, right? That one is not true.
It's not true.
Yes, sir.
It's not true. Me, I go be I'm planning to come to your DM self. Like, Maybe after this class.
If you are Ghana, sir.
Yeah, no. So, please, who will read?
Required. Prepare calculations to show the optimum replacement cycle for the restaurant's oven and state your recommendation. B.
Thank you.
Explain to. Okay. Thank you, sir.
Thank you. Thank you. Now, prepare calculations to show the optimum replacement cycle for the restaurants. When are they going to replace the oven that they use? Is it after 1 year, or is it every 1 year, or 2 years, or 3 years? And this is replacement theory. Explain two limitations of your solution. Please, you may see a question on replacement theory. It is what it is, class. So the question now, continue the question, please, quickly.
A restaurant chain is considering when to replace its oven. Each oven has a purchase cost of 14,000. The restaurant needs to decide whether to replace its oven after 1 year, after 2 years, or after 3 years. The following okay.
Thank you. Now, a restaurant chain is considering when to replace its ovens. Each oven has a purchase cost of 14,000. The restaurant needs to decide whether to replace its ovens either after 1 year, after 1 year, right? After 2 years, or after 3 years, right? We will decide. And the purchase costs, each oven has a purchase cost. We don't know the numbers of oven that they have. So please don't go and multiply by 3 because it is 3 years. I know. Please, we don't know the numbers of ovens that they have, right? So you cannot just assume that there are 3 years because it is 3. Then you now assume it is 3. You multiply by no, class. The 14,000 is like an initial cost of that particular oven, class. Is the costs of the oven, right? And on a year-on-year basis, if you have an initial investment of 14,000 of that oven, operating costs, excuse me, maybe labors, the labor, the maintenance, you incur operating costs, maybe labor, the maintenance costs. Every year, you see that the maintenance cost is increasing, the operating cost is increasing on year basis. Trade-in value at the end of the year. What is trade-in value? Means the scrap value of that asset at what? At the end of that year is 10 million, is 10,000. Sorry, it's 10 million. I better go. I be 10 million, they come. Ne? So it's 10, it's 10,000, 7,000, 5,000. The company cost of capital for this type of decision is 12%. They will give you the cost of capital to be 12%. Now, something just came to my mind. So now let's quickly check something back. Under the normal capital investment, you know, they usually give us the nominal cost of capital or the real cost of capital. If the cash flow is real, you use real cost of capital to discount. If the cash flow is money, you use money cost of capital to discount. Or if the cash flow is money and they give you real cost of capital, you know you need to convert to money cost of capital. But class, in a situation whereby whether it is real or it is money is not given to you, whether it is money or it is real, if it is not given to you, class, you have to, definitely they will give you the ingredients that you will use to determine the weighted average cost of capital, just the usual way, class. Whenever they're supposed to give you either it is real, either it is money, they're supposed to give you a cost of capital that you will use to discount the project. And you didn't see any cost of capital, but they give you some information that you will use to determine the weighted average cost of capital. Maybe the cost of debt, they give you the market value, they give you this, they give you that, meaning that you have to use that to determine the cost, weighted average cost of capital. But at your level, I don't think I can make test. I can. They may test. So I'm just preparing your mind ahead, right? Because that is only covered at professional level in SFM, right? Now, should in case again, maybe you are reading the question, they now tell you that the company want to diversify, and in that question, under the capital investment, and in that question, they're supposed to give you money or read that you use to discount, and they didn't give you. So what you need to do, you have to determine the appropriate cost of capital that you will use to discount that project because the company want to diversify. I'm just preparing your mind ahead of the worst case scenario, although it may not cover in your syllabus, but I'm just preparing you ahead. Maybe you may or you may not see it, class. Now, the company cost of capital for this type of decision is 12% per annum. So, what is all this sticker and this thing? It's in the apple now. I bet me too. I threw my own. I might throw my own. Maybe everybody they laugh. So, so anyhow, just be fair, you know. I've, in fact, the way I take that cost of capital and project specific, you should be able to at least, when the desirable is not available. When the desirable is not available, the available becomes okay. Okay. Give them the phone. So now, suggested solution quickly before we go. Then we'll come back at 8:30. Portfolio theory, suggested solution. Although I have a pre-recorded video on for portfolio theory, but because it is FM, right? Most of you or many of you have not done it before. Portfolio theory, so it may kind of, although the recorded video is actually is well detailed, right? If you watch it, you will know that yes, I explained portfolio theory from the beginning to the end. In fact, I even solved questions on it. I can and ECCA, right? But well, I don't know. At the spirit lead, I may decide to take portfolio theory or cash flow forecast or business valuation, right? Let's see, any of the three, right? So there's a solution. So we need to decide when to replace. Already we have the initial costs of this class. So what you will do, class, what is the name of the company? No name, no name. So I will use IB. Should I use IB or next gen? IB Kudus. Yes.
Yes, Jerry.
Let me use Kudus.
I use So I use the next
Use
gen, sir.
no name limited. No name limited.
Next gen professional associates. Let's assume we have restaurant in Abuja, right? So let's assume this is the name of the company, right? So we need to start 1 year replacements every 1 year. Let's start it. Replacements every 1 year, or every end of the, maybe at the end of 1 year. Anyone? Class, the usual MPV, year, items, cash flow, GCF, present value. Class, this is for year 1. Class, and we have the initial costs. This is initial costs of the oven. Please don't go and multiply by 4 and 3 and say, they say each. The question did not state the numbers of oven, right? So year 0, initial costs is 14,000. So I'm adding the decision tree immediately after this class. Decision tree and simulation. Please go and watch it. So I will add it immediately after this class now. Just pick the decision tree part of it, right? You can fast forward to the part of decision tree. Then what is it called? Then the simulation. Initial cost is 14,000. The cost of capital, 12%. Right? 12%, 14,000. So at year 1, they have operating costs, the labor, right? Operation. At year 1, operating costs. What is the operating cost, class? Operating cost,
5,000.
5,000. So please, what is the DCF for year 1?
0.893.
0.893. Don't forget, is the cost. What do you have? When you multiply quickly, please.
$960.
4,465.
4,009.
465.
4,000 what? Where is
465. 465.
4,465.
okay. 465. Because it is a cost, right? That is why it's in that way. I jacket it, right? Right. So the next thing we have here, maintenance costs. Same year, maintenance costs. Maintenance costs 1,000. 1,000 0.893. Class, what do we have?
893.
893.
893. 893 because it is a cost. The last one is trade value. Trade value means scrap value. It's scrap value. The amount they can trade it at the end of that year. Trade value. So what is the trade value?
10,000.
10,000.
10,000. Yeah.
10,000 at 0.893. So what do we have?
8,930.
8,930.
8,930. What do we have? What is the MPV? What is the MPV?
10,428.
Negative or positive?
Negative.
10,000.
428.
10,428. Right? 10,428. Negative. This is the MPV. MPV. Plus. The next thing you need to calculate is what we call, wow, 19. So fast. Wow. A minute, please. So we need to calculate the equivalent minutes. Okay. We need to calculate equivalent to decide equivalent annual annuity. It is calculated as the MPV divided by the DCF for the year one. DCF for the year one. So therefore, we can have 10,428 divided by the DCF for year one is 0.8989, right?
Yes, sir.
Okay.
893.
0.893. What is the equivalent annual annuity?
11,677.49.
11,677.
677.49.
Okay. That one is not material. Yeah. Right. It's not up to 5. So this is the equivalent annual annuity. That is what we'll be working with. And we should not forget that it's negative. So we move to replacements every 2 years. Right? Replacements every 2 years. 2 years. A minute. I'm trying to check. Okay. Oh, can copy this. Okay. Replacement every 2 years. Oh. Wow. So how many percent is this? 2. Okay. If I can finish this thing, I'll be happy. Oh shit. Okay. Quickly. Replacement every 2 years. So we say half year items, the cash flow, DCF is 12, the PV, right? So you can decide to, since operating costs and maintenance costs are the same, sometimes you can actually add it together because they are costs. So at year zero, we have the initial costs to be 14,000. This will be 1 and 14. Now, in year 2, we have operating costs. Is that not so? In year 2, we have operating costs. Class, you should not forget that the costs of a machine will keep on increasing on year basis. And it will be a cumulative cost. Listen, no, it will be a cumulative cost, meaning that what did you incur in year 1? You need to add what you incur in year 1 to what you incur in year 2. You need to add what you incur in year 2 to what you incurred in year 3. So therefore, I can copy the operating costs and the maintenance costs that are incurred, just the costs, because it will be a cumulative cost. It's just like you buy an asset this year. How much did you incur? Then you look at it. How much did you incur? Did you incur in 2024? How much did you incur? What is the total cost? You need to consider it, class. So it will be a cumulative, the operating cost, the cost that you incur. So we pick it. I can paste this, just copy this to be a cumulative cost. Then you can now add the maintenance costs and operating costs of year 1 and year of year 2. Should I just add this thing together so that, okay, let me add the year 2 together. Operating, so I will save time. Operating and maintenance. So what is, add the operating cost and maintenance costs of year 2. When you add it, what do you have?
8,000.
8,000. 8,000.
Okay.
8,000.
8,000. A minute, please. I don't know what happened. 8,000 is the maintenance cost. 8,000 is the maintenance costs. 8,000. So what would be the DCF for year 2?
797. 0.797.
0.797.
97.
Okay, when you multiply the cost, what do you have?
That will give us 6,376.
6,376. Right, 6,376. We have year 2, the trade value. Of course, the trade value of year 1 will be different from year 2 because the depreciation
Sorry,
has
sir.
taken place and the
Wait, sorry, excuse me, sir. The cost that you're having, is it not total of both the operating cost and maintenance cost for, you said cumulative now, year 1 and 2 added together?
this one, this
The year
this
2 you are
part.
working on now, yes.
Yes, I've added this. This is it. Year 1, this is for year 1. This is for year 2. Operating cost and maintenance. Operating and maintenance. I'm supposed to put maintenance here.
For adding everything, I think it's supposed to be like 14,000. It's not to add the 5,000 plus 1,000 in year 1 and then add year 2 on 2.
No.
Okay.
I said add the operating and maintenance of just year 2.
Year 2, okay.
Yeah. So trade value, right? Trade value. What is the trade value? Which is the scrap value?
7,000.
The scrap value. 7,000. You can see that the trade value decrease because of the use of the assets. Right? 7,000. This is 0.797. When you multiply this, what do you have?
5,579.
5,579 class. What would be the MPV? What would be the MPV?
Minus
negative
20,155. Minus 20.
Okay. Minus what?
2155.
Okay, 2155. So we need to determine the equivalent annual annuity to decide. We know we are incurring costs because we have a negative MPV, but we need to minimize our costs. That is what it means, class. So therefore, the equivalent annual annuity, the equivalent annual annuity 2155 divided by place. Add all the DCF from year 1 to year 2. What do you have?
1.690.
1.690. 1.690. You can use annuity year 1 to 2, whichever one. So, what do we have here?
11,296.
11,296.
926.
Right? Because it is negative. We need to minimize our costs by looking for the lowest equivalent annual annuity, the one that will give you the lowest cost, then you will now advise that they should take either A or B class. Lastly, I can just copy this, right, for the replacement. The replacement every 3 years, right? The replacements every 3 years. We still need the cumulative costs you incur in year 1, in year 2 class. Of course, you need the initial cost, the operating cost you incur in year 1, the maintenance of year 1, operating and maintenance costs of year 2. So we can have year 3, operating and maintenance costs of year 3, operating and maintenance costs of year 3. What is the operating and maintenance costs of year 3?
95. 9,500.
95. You can see the scrap value decreases as you are using the asset. The scrap value decrease. What is the DCF?
0.712.
0.
0.712.
0.712. So what do we have here?
$6,764.
6,764. The trade value. Of course, the value of the scrap value will be decreasing as you are using the asset, while the cost will be increasing. Of course, you will keep on increasing, you keep on incurring cost on that asset.
5,000.
So what is the trade value?
5,000.
5,000. So 0.712. What do we have here?
3,560.
3,560. So we can add this together, or you use annuity. You can just do annuity year 1 to 3. Please, what do we have here?
The NPV is minus 28.
2.40.
The NPV is what?
Minus
Plus 28,938.
Okay. The NPV is minus
28,938.
28,938. So what do we have when you add this DCF together? What do you have? Quickly, class. What do you have? Or you check annuity table quickly.
2.402.
2.402. So equivalent annual annuity we have 28,938 divided by 2.402. What do we have?
12,000. Minus 12,047.
12,000. 12,000 what?
047.
047. So because it has a negative MPV class, because it has a negative MPV, we need to look for the lowest costs. We need to look for the lowest costs because it will cost the company. They are incurring a cost. They can't do away with the cost because they have to continue with the restaurant. But when are they going to be replacing the assets? In order to minimize their costs. So you choose the lowest equivalent annual annuity class. When should you expect the company to replace its asset class? Class, are we still together?
Year one.
Year
One,
one.
sir. Yes.
So you can conclude that the optimum replacement is year one because it has the lowest costs of 11,677. In order to minimize their costs, they need to replace on every 1 year. Every year. Interesting. Please, that will be the end of replacement theory class. The limitation. This may not be realistic. This will be the end of replacement theory. Distinguished professional colleagues, I think I have to go. Right? My system is very low, right? So I need to go. Quickly.
Sir, my network was not okay when you were explaining that year too. So I don't know
You
if you
can check that.
repeated.
No, you can just check on YouTube. Sorry. Just check on YouTube. Yeah, just check. It's there now. You can just check on YouTube.
Please, can you
Thank you.
scroll down for year 3? Replacement every year 3.
Please scroll down for year 3.
Kudus, quickly.
Okay, thank you, sir. Sorry, my question is not on this. My question is on cost of capital, please. Do we calculate cost of debt for overdraft, please?
No. You don't determine the cost of overdraft. You only determine the cost of bank loan. What is overdraft? What is overdraft? When you withdraw more than what you have in your account, it will cost you, but it will not be that much. It will cost you, but you don't need to determine the cost of an overdraft. It is when it is loan before you can say you want to determine the cost. Thank you. So I need to go. My system is very low. So I have to go now. We'll come back at 8:30. Silas.
Sir, good evening.
Good evening. Quickly, please.
All right. Sir, I want to really understand the logic behind this replacement theory because
the logic is that let me explain to you. Every year you need to be incurring costs. The cost you incur year 1, year 2 is a cumulative. That is the logic, right? The thing is that they have a negative MPV. They have to minimize their costs because they have a negative MPV. So they need to look for the lowest MPV. But in a situation whereby they have a positive MPV and they ask you, what year should they be replacing? It is the one that have the highest equivalent annual growth rate. the higher one if it is positive NPV. And that is the logic. When it has negative, you look for the lowest to minimize. If it has a positive, you look for the higher equivalent annual annuity to get your for maximization. So every year your cost will be increasing. So it is a cumulative. The one you incur in year 1, add it to year 2. The one you have in year 2, add it to year 3. The one you had in year 4, add it to year 4. That is how it works. Thank you. Do you have any other one? Any other question? Okay. So thank you so much, everyone. We'll be back at 8:30 as the spirit lead, right? We may look at portfolio theory or cash flow forecast or business valuation, right? So whichever way. So we need to prepare for another topic. So make sure you solve question. I will check if I have more question on this, on replacement theory. I will share if I have. You just, yes, I think I have. There are some questions that I just keep them for intensive. I don't need to, we'll keep all those questions for intensive class, right? So like this, if I will check, then I will share, right? I will share it, as well as the decision tree. I will also share a question on decision tree. Please go and watch the video on decision tree and simulation. I will add it right now to the playlist. I assume that we've covered the decision tree and simulation. So thank you so much, everyone, for joining, and see you at 8:30. Thank you.
Thank you, sir.
Thank you.